If you are watching this event, Essential Alternatives, no doubt you have an interest in private credit. I mean, it has absolutely exploded in visibility over the past couple of years for not just wholesale, but retail investors as well. So here to run us through what we need to know about private credit now, a very warm welcome to Mark Zuckerman, who's joining us from Vado Private. Welcome to Essential Alternatives.
Thank you for inviting me.
So the big question on all investors' minds, you've got a lot of market volatility, you've got low deposit rates. So what is behind this real push that is making private credit just, suddenly become in such demand?
Well, private credit gives you a healthy premium above the RBA cash rate. And what we're seeing now with investors and self-funded retirees is that they're really looking for income from their nest egg, and they want to preserve that nest egg. They don't want that exposure to volatility that we saw with the stock markets when Trump announced tariffs in April 2015. Private credit can offer you more stable, more predictable returns without the volatility, and it's all about capital preservation.
Mm-hmm. So private credit is gaining traction, we know this. What makes Vado's approach different from some of the other major players in this space?
Yeah, we've been established since 2017, so we've experienced the highs and lows of real estate and debt markets. We've survived COVID. We've written over $550 million of transactions, no capital loss to any investors. We know the market. We're in the market. We work on more granular size loans. We're not big players at the top end of town. The projects we fund are typically smaller scale projects, less duration, might be less construction risk, less term. And what we do is we sift and review a lot of transactions. A lot of transactions come across our desks. We probably do 2 to 3%. So that's a lot of no's. But the ones we do back, we back fully. We package them up, we present them to our investors on an individual basis. So our investors, our wholesale investors, can look at each individual transaction from start to finish, ask us questions about it. They have full transparency. Ideally, they commit to us and we fund it and transact on the next one. But if they say, no, Mark, it's not for me, then we move on. Mm-hmm. So we offer the investor full visibility on each and every transaction.
So term deposits are below 4% right now, but you're targeting between 8 and 12%. How can you deliver that higher return without taking on sort of equity style risk?
Sure. We play in the middle market borrower space in Australia, and these are clients that might borrow between $5 and $20 million. They're typically too large a client for bank products, over-the-counter services, and a little too small for the bank's tailored products that are usually at the institutional level. So what we find is we've got a really nice borrower base that is discerning. They know what they're doing, they're experienced, they've got equity in the transaction, and they're prepared to pay a premium above what they would pay at a bank. And now that premium is not significant. It's certainly not multi-digit. It's a healthy premium that allows us to return those rates to investors, the 8 to 12%. Obviously, what we do as Vado, we manage the process from start to finish with the borrower, and we manage the process from start to finish with the investor. We keep them fully informed along the way, and we collect interest and line fees from the borrower. We take our margin for managing the relationship, and we distribute the balance to our investors.
So at Vado, you focus on loans that are secured by real estate. So why is real estate that tangible security? I suppose, how important is it when you're thinking about capital preservation?
Yeah. Real estate is obviously an asset class that the majority of people are very, very familiar with. They might have an opinion on it being a good asset or a bad asset, but either way, people in Australia have opinions on it. But what we find with real estate is it's a very tradable asset class. And it is tangible. It has a valuation that people understand. If it's a residential property, people can find information that supports that value on the open market in the public domain. It's visible. What we don't lend against are intangibles like copyright, intellectual property, stocks, debtors. That's certainly not our space. We're simple folk. We focus on real estate, and that real estate can be land, it can be residential improved, it can be development sites, it can be commercial, industrial, and retail.
So, you've been lending since 2017. Correct me if I'm wrong, but you did say without any
Yes.
loss of investor capital. So, what safeguards or disciplines do you have in place that really allows you to continue to protect investors to that degree?
Sure. We've got a lot of established processes and policies in place. As you can probably tell, I'm getting along in the tooth, and my co-director, we share some similar experience in banking and non-banking and funds management. But with those policies and procedures, we stick to them. We don't like exceptions or making exceptions for transactions that sit slightly outside of our policy. And one of the advantages we've got, I guess, in not being a volume-driven lender is we don't have that weight of capital, investor capital, sitting on our heads and forcing us out there to deploy it into transactions we're not fully committed to do. We are a bottom-up operator. We source the loan first. So our judgment is not clouded by the need to get money out from investors. We concentrate on the underlying asset. If that asset meets our criteria and we're happy with it, then we'll look to raise the money. A lot of the other large operators do work the other way. They've got a lot of inflows, investor inflows that they've got to move. And I guess that's the difference. We're a niche operator rather than a volume operator.
So most of your loans are short-term, between 9 and 18 months. So how does that help, I suppose, with risk management, but also flexibility for investors?
Yeah, we prefer a shorter loan term. Typically everything we do is under 24 months. The reason for that is twofold. The size of the transaction that we lend to are typically not your complex project. That's not our space. There are other people who want to play in that space. Our projects are typically shorter duration, so there's less construction risk. We saw with COVID, if you're funding a very large project and you're halfway through and we get an event like COVID, that creates a real problem on a very big project. We focus on smaller size transactions where there are a lot more exits. We don't deal with complex builds. So our transaction terms, our construction terms, we're usually out of a project 15 to 18 months.
So, you've mentioned that investors can sort of pick and choose which specific loans they want to fund. Is that unusual, that level of transparency and control, I suppose, in this space?
In pooled funds, blind pooled funds, you don't generally get that. You're presented with parameters that the fund will invest in. But in this market, particularly with the risk of loss around private credit, we've always been the view of let's transact on a fully informed basis with our investors. We don't put pressure on them. We present the whole picture to them. If they like the transaction, fantastic. If it's a no, we move on to the next one, and hopefully they do like the next one. And there's various reasons why they do and why they don't. Mm-hmm. But they have full discretion, full choice around what they decide to invest in.
Yeah, really interesting. And private credit is often described as defensive. We talked about the economic uncertainty, right around. I mean, interest rates are falling. So, in your view, why is private credit such a good diversifier alongside, equities and bonds?
Yeah, firstly, it delivers a healthy premium above the cash rate. So you've got a margin above the current levels of inflation. You're getting ahead of you're getting an increased purchasing power. It is a defensive asset class in that it's all about capital preservation. So hence, we always lend on a fully tangibly secured basis by real estate. It offers investors structural protection in that the borrower has to execute security documents. We've got a loan agreement, and there are obligations that the borrower has to keep to. It doesn't have a high correlation with other asset classes, which is good. And it also delivers a stable and regular return to investors.
So a lot of investors worry, and I think you alluded to this earlier, that fund managers will chase growth, they'll lower their standards. So how do you at Vado Private resist that temptation, I suppose, and really stick with your bottom-up approach?
Yeah, it is a temptation. We're very conscious of our track record, zero loss, over $500 million in loans that we've originated and managed. Having those policies in place, I guess that keeps us in check. They are quite rigid. It doesn't, we're not weighed down by that capital compromising our standards and the way we do our business. We're very much focused on, is this a good transaction before we start looking at the capital raising. I think that keeps us, one of the reasons keeps us on the straight and narrow, but also the alignment we've got. We co-invest in a lot of our transactions, so why would we risk our capital and our history and our experience and our I guess our dedication to our business for a quick return, or that might compromise our standards, particularly when we've got the money in the transaction alongside.
So, Mark, looking ahead, what do you see as the biggest opportunity, perhaps the biggest challenge facing Australian investors, in the private credit space over the next couple of years, say?
With the growth in the sector and the number of new entrants coming in and the amount of capital that is coming into the space, very positive signs ahead. But what it means for investors is it just emphasises the importance that they pick a manager that they are comfortable with, that has a good track record, that is an established player, that is committed to the industry and not just there for the short term.
Mark Zuckerman, Vado Private, thank you so much for joining us.
Nadine, thank you. Thank you for your time.
You're
Appreciate
welcome.
it.